Hello, this is Andy Hill speaking of Andrew Hill Investment Advisors. Recently, I've observed that the reporters on CNBC and Bloomberg have been asking the question of their guests if the stock market is in a bubble or not. I wanted to take a harder look at this question and share with you some of my observations. First, let's take a look at the history of bubbles. The one that's written about the most in textbooks is the Dutch tulip bulb mania back in the 1600s. The stock market bubble that burst in 1929 with the great stock market crash and leading to stocks losing about 90% of their value over the next few years is certainly one we still have in mind. Gold in the 1980s was another bubble. The technology and dot-com craze concluded in the year 2000, although some of the sentiment ended up going into the real estate market, which, depending where you are in the country, climaxed in the year 2005 to 2007. So let's take a look at the characteristics that we find in financial market bubbles. First, expanding valuation. In stocks, we usually use a price to earnings multiple as a way to measure stocks. Higher the PE ratio, the potential for being overvalued. And typically when we get into a bubble situation, we're finding all kinds of new paradigms to value things, ultimately which never make any sense. Second, there's extreme confidence in that new asset. Typically that's associated with a new paradigm or way of thinking. Third, there's excessive ownership of that asset, which is usually compounded by a new form of financial leverage or borrowed money. We're quite familiar with that more recently, as anyone who could write their name at the bottom of a piece of paper, which turned out to be later a mortgage document, would have money for the purchase of a new piece of real estate. Let's take a look at whether we're in a bubble now with the S&P 500 trading just a little bit above 1800 today. First, expanding valuation. No, we don't make it on that criteria because the price to earnings ratio based on estimates for next year's earnings, according to Argus Research, is about 16. So that's just in line with the average for the last 20 years. Second, extreme confidence. Well, some of our advisory sentiment readings are a little too bullish, and we tend to like to be in a contrarian, so that's a little bit of a concern. But the social trends towards investing in risky assets such as stocks still remains rather negative. Just think of every time there's news coming out of Washington, typically that's bad and quite often leads to foregoing making investments. Third, excessive ownership. Well, what we'll look at here is mutual fund flows, where investors either buying or selling funds. And investors have actually been taking money out of mutual funds for a number of years and only have, in the last 6 months or so, have begun buying more equity funds. So excessive ownership of the stock market certainly is not in play. Further, I also am aware that a number of very large institutional investors have been under allocating to stocks for a number of years. Let's take a look at a chart of the S&P 500 just to illustrate some of these points. Most clients will recognize this chart as I use it in a lot of our meetings as it dates back to 1995. Typically we find bubbles at the end of an economic cycle when everybody is optimistic and thinking the trend will go on forever. We saw that in the year 2000 with the technology peak, and we saw that in the real estate, or otherwise known as a credit bubble, peak in the year 2007. So as we look to today, we see a rather unique situation where we're just broken into all-time highs on the S&P 500 and may possibly be beginning a new long-term or secular bull market in stocks. So at this point, it doesn't look like today we are in a bull market. So for those of you that would like to learn more about bubbles and other manias that have gone over in time, I suggest you read the book Bubbles, Extraordinary Popular Delusions, and the Madness of the Crowds written by Charles Mackay. I read this book about 20 years ago, and it's probably about time I went back and read it again. So with that in mind, we aren't in a bubble yet. Just because stocks are having a good year, that does not necessarily mean that we are in a bubble just yet. So with that, I thank you for listening, and I'm Andy Hill.